get to 1 million ounces. Well, what's 1 million ounces of gold worth? Gold's selling at roughly $2,000 an ounce, right? So that's $2 billion. So that stock went from 15 cents when I joined them, and it exited at $29.
Hello, everybody. Welcome back to another episode of the podcast. In this episode, I'm joined by Knox Henderson. Knox Henderson is a seasoned communication and capital market professional with over 2 decades of experience. Mr. Knox has been raising capital for Toronto Stock Exchange companies. Mr. Knox has co-led CEO's financing of more than $100 million on the Toronto Stock Exchange. Mr. Knox is currently serving as the Vice President of Corporate Development at Canagold, a company focusing on advancing Western Canada's highest gold grade product. Let me know in the comments down below what you guys thought of this episode, and hope you guys enjoy. So hello everybody. Welcome back to another episode of my podcast. In this episode, I'm joined by Knox Henderson. So welcome, Knox, to the podcast.
Hi, Mohammed. How are you?
I'm doing good. How about you?
Great.
Okay, so I guess we'll start off. First of all, you can tell the people what you do.
Okay, I guess I'm a capital markets advisor and a corporate communications advisor as well. So what does that mean? I work for publicly listed companies and help them raise money. And then on a wholesale level, when you're doing financing, and then on a retail level, when you're trying to get more people involved on the retail level, involved in your stock. So broadcasting the news about the company in order to gain shareholder value for the company.
Mm-hmm. So what inspired you to focus on like investor, public media, like this marketing communications field, like this sector?
Well, it was kind of an odd beginning because I didn't know what the heck I wanted to do out of high school. So I just went straight to the stock market in the 80s and applied. And I was initially a runner. I'd run stock from building to building. And all I had was my high school diploma at that time. And eventually I needed to get my Canadian securities course. So I took that course, which is enables you to become a stockbroker or a trader on the Vancouver market. So after I got that, I became a trader on the Vancouver Stock Exchange. So that was kind of fun because it was interesting to see. It was quite the rally in the 80s. Gold was very high. Interest rates were also really high at that time. But there was a lot of interest in some of these mining discoveries in Ontario. And these stocks were, flying high, and it was fun to be on the floor and actually organically see people, bidding for something. You see the rally actually take place live. So that was a very exciting time for me, for sure. And then after I did that for a few years, I kind of scratched my head and said, "Is this what I want to do for the rest of my life? I don't know." So I went back to school, took journalism. And then following that, then I ended up working in the tech space because now we're getting into the 90s and the tech boom and all that. And then ended up doing corporate communications and public relations for technology companies. And so that was fun and interesting. And I worked for some NASDAQ listed companies and private companies. And I also did consulting during the tech boom. One of them was a NASDAQ listed company called Nice Systems. That was the sort of the peak of it. They did digital monitoring and recording for your call, maybe recorded for quality monitoring services, and that was sold to Fortune 500 companies like Bank of America and Progressive Insurance. So that was really at its peak. 1999, just before the tech bubble burst, and so I learned a lot about communications and working with global agencies and working with publicly listed companies. But towards the end of that, it was sort of recognized, wait a minute, Knox, you have your Canadian securities course and you were a trader, so you understand the capital markets. So why don't you do investor relations? Because you know the communications side on the technology side from the journalism side, and then the trading and the capital market side from your days as a trader with your Canadian securities course. So it made sense. So I started doing that. But then, like I say, the tech bubble burst. And that's when I decided to get back into the mining space because all the people that I went to high school with that ended up being brokers or traders. A lot of them ended up in the mining space because Vancouver is where all the geologists are in Canada. Like Canada is the world leader in this space, in mining exploration around the world. I don't care if it's gold, copper, zinc, uranium. Canada is the leader. And most of the companies are based in Vancouver because that's where all the geologists are. They all came out of UBC in geology. And all the money, of course, is in Toronto. But historically, that's how it's always worked in Canada. When I was a trader in the Vancouver Stock Exchange, it was the Vancouver Stock Exchange, but that eventually morphed into the TSX. So that's why it's called the TSX V for venture, but I would people would say V is for Vancouver.
Mhm.
So anyways.
Yeah, so just for context for people who are listening outside of Canada, so UBC is the University of British Columbia, which is the westernmost province of Canada, and TSX is Toronto Stock Exchange. So,
Correct.
okay, so I guess this is something that I want to learn like a lot about, like learn about investing in general. So I guess we'll start from the top, and hopefully people listening, you'll guys find this valuable as well. So I guess let's start like from the absolute like core. So what exactly is investing? Like this concept of like investing in general, like what is this?
Investing is acquiring a share, a piece of an asset that you believe in the future will be worth more. And it is what a lot of people get confused with is investment really is not directly correlated with earnings. Just because in one quarter you had really good earnings doesn't mean your stock is going to automatically go up. I mean, generally it would if you were on a track record where that happens. But a lot of people get confused that earnings are directly tied to the investment value of something. So that's kind of what investing is at its core.
Mm-hmm. And so now expanding one level further, so what is like resource investing, like research, like investing in these natural resources, like gold mining and so on. So what is this concept?
So the concept in tried and true out of Vancouver and Canada is basically in simplistic form the ideal scenario is you find a piece of land next to probably an existing mine that was probably on a major break. In Canada, there's these major faults and breaks that span across provinces, like in Quebec and Ontario, and in British Columbia. So you get a plot of land, probably on the same trend as an existing mine is probably the best place to start because you want to up your chances. Then you lay claim onto the property, and you have to pay property fees and claim fees. And then you raise some money to drill it. So, but first off, you would do ground surveys and mag and induced polarization. You'd look at conductivity and resistivity and gravity and all that kind of stuff to sort of identify the similar type of anomaly that you have from that mine down the street, right? So you get the rock type and the mineralization type from the mine down the street, and then you do all these ground surveys on your land and hope that this lights up, it looks a lot like that one down there 50 kilometers down the road here on the same break. So now we have some decent intel about this property. So the next thing you would do is raise some money and do some drilling, and typically early stage you're going to raise I don't know, $1 million, $2 million, because it costs you probably about $300 to $500 a meter to drill. And you drill these targets that you've identified, and then you pray that you hit some decent intercepts, because if that happens, then the value of what you have, you might be $1 million valuation based on all the money that you've put into this thing. So this company is worth $1 million because it's got this ground and they've raised $1 million cash. I'm just putting this as simply as possible. And then you've hit some decent mineralization, and they're going, it looks like there's going to be some gold there because it's very similar to that mine down the street, So then the valuation of it, you would theoretically go up because you've now added some value to the asset. And then by then, so you did your first round, you did 10 million shares at 10 cents, and that's your $1 million. Well, now I'm going to need another, $5 million, but I think I can raise it at a higher price because we've hit this gold. So then you can raise 3 million at 30 cents. So you're issuing less stock, the higher you go up, and then you drill again, and hopefully you hit gold, and it gets bigger and bigger, and then soon you've got all these intercepts, and you've defined a blob, which is a resource, and then all you're trying to do is make that blob bigger and bigger and bigger, and you're increasing the value, and you're constantly raising money as you're going along. So an exploration company never makes money. Like, you don't invest in an exploration company in gold to wait for it to become a mine, because it's going to take 5 to 10 years for it to ever be a mine. What you're investing in is a point in time from this thing was just a moose pasture. Then we drilled it, and my gosh, there's gold down there. It's very similar to that mine, 5 kilometers down the road. So this could be something, right? And typically you want to build these things out to probably at least 500,000 ounces. And I'm talking specifically gold here. you get to 1,000,000 ounces. Well, what's 1,000,000 ounces of gold worth? Gold's selling at roughly $2,000 an ounce, right? So that's $2 billion. So, but it's in the ground. So all you're trying to do is you're defining these blobs, and there's a thing called NI 43-101, which is the standards of measuring all your drilling and all your intercepts that you can kind of calculate how much you think is down there. So that's a bit of a game, but when you know that there's this mine 10 kilometers down the road and they had 2 million ounces and they drilled with 30-meter spacing and they found this much gold, chances are this is going to be very similar. So basically you're buying that point in time where you're taking the valuation from nothing to something. And it's very difficult. 1 out of 1,000 of these actually discover a deposit. And then after they discover the deposit, then you have to do the engineering. Like, how are we going to mine this thing? How deep is the shaft and how big is the open pit? And then by the time you apply the economics to the mine based on the grade of the gold, well, is this thing still going to be profitable? And so a lot of them actually fail. Like, there's been big mines that have been built for $1 billion. And by the time they actually mined it, it didn't have the grade that they needed to break even. And the typical, right now, gold's trading at, I don't know, $1,800 an ounce. The average mine costs, all in sustaining costs, is about $1,000. So, you need to have that gold price up there to make that
balance it
lever.
out.
So the stages are exploration. You drill it out, you get a resource, let's say 1,000,000 ounces of gold, fantastic. Our particular project at New Polaris in Canada, it's one of the highest grade gold projects in Western Canada. It's probably the highest one being developed right now. So you have that high grade, then you can apply the economics and how are you going to mine this thing. We can sustain quite a bit of cash cost because each ton of rock is worth so much, because we don't have 1 gram of gold per ton, we have 10 grams of gold per ton. So that by the time you apply the economics to it, in our PEA, or preliminary economic assessment, we figured it out, it worked out to $540 US an ounce, which is really good. And that's because it's a small mine, it's a small mill, because the grade of the gold is so high. So we don't need a big, huge mill. So anyways, that's our project. So there's exploration, you drill to define a resource, then you do the economic studies, which is called the development stage. And then, once you've proven that you can mine this thing, it's going to be economic, and you're in an area that you can permit, you have good local community relations, then you would actually start going into production and going to the banks. We're at the stage where we're doing a bankable feasibility study, meaning that when we come out with these new numbers, because we've done more drilling, we've done more economic studies and more environmental studies, when we have a full feasibility, then we can go to a bank and say, this mine is worth $500 million. It's going to cost us about $200 million to build it. Will you lend us the money? Yeah. So that's how that works. Mm-hmm. So as an investor, sorry, go ahead.
Sorry, no, please continue.
What I was going to say is that as an investor in mining, there's something called the Lassonde curve. It was developed by a guy named Pierre Lassonde, Lassond. And that curve shows you the initial stage of when you've got a tight share structure. You don't have a heck of a lot of shareholders. You got a little bit of cash, but you hit some gold. So your stock price jumps up a lot because you've only got 30 million shareholders, right? I mean, these companies, they go up to 500 million shareholders. So when you have a tight share structure, a few shareholders, you've got a little bit of cash, and you actually hit something, that's called, that's the exploration stage of the Lassonde curve. So that's going to go up. That's the best time to make money. And then as you build it out, I've got 1 million ounces. No, I've got 2 million ounces. That's fantastic. Now I'm going to start applying economics to it. Oh, it's going to cost us, $800 an ounce to build it. Okay, so now your valuation of your company goes up to the top of the Lassonde curve. Then you raise a whole bunch of money to build the mine, and you got to issue 50 million shares or 100 million shares, and you got to raise $200 million of debt. Now the value of the stock goes down because it gets so diluted, and you're taking on debt. So that's called the orphan period of development. So we're getting towards that. And the only time, but you want to invest in this early stage. This is where all the fun is. This is where the quick money is. This is where the one company I worked with was called Great Bear Resources, and it was probably the most successful one in Canada in a lot of years. I mean, that one had a tight share structure. We hit very good high grade gold. Stock went up. We raised more money. We hit more very good high grade gold. Stock went up. We raised more money. We started with 10 million shares when I joined them. When they sold to Kinross, they only had 60 million shares, which is not a lot for a company, but they were trading at $29. So that stock went from 15 cents when I joined them, and it exited at $29. Like that's a once, that's not something I do every day, but that was obviously a very exciting experience. So that's the dream. Like if you look at Great Bear Resources, that is the dream. But there's a lot of things that happen on the way. You don't hit the goal right away. You're in the wrong area. It doesn't mean that it's not there. It's just it. So the key thing to remember are the 3 P's. It's people, property, and place. So the people behind it, do they have a track record? Have they done this before? The property, what's the asset? Is it gold? Is it copper? Is it a long strike with other mines? Does it look like other mines? Is it a place that you can actually permit it? And then, the place is where is it? Is it in a good jurisdiction? For gold, the best jurisdictions are British Columbia, Ontario, Quebec, Nevada, Mexico, and then those are your top tiers. Everything else there's some awesome deposits in South America that are really high grade and really low cost, but you've got to find the right jurisdiction, and you got to find the right team that knows how to stick handle these jurisdictions, and you have to have the right local team that can help you stick handle these jurisdictions. So the safe investor goes for BC and Canada and the US. California can be sticky. There's a lot of special interest groups in California, and you got to avoid cities and all that. And but North America is certainly up there in jurisdictions, and certainly British Columbia and Canada is way up there.
Well, that was a super good explanation. I think it's in my head, it's starting to make sense now as well. But a couple of questions I have. So one thing you mentioned at the start was during the exploration phase, so when you're looking to build a new mine, you usually do it near other previous mines. Yeah. And you mentioned the word called, there's some mines break, or there's a lot of breaks in Canada, or along those lines?
There's these big faults that break across the Canadian Shield, for example. In Ontario and Quebec, there's the Cadillac Larder break. There's breaks along Timmins. So these are areas where, like at Timmins and Kirkland, Ontario, along the Abitibi Greenstone Belt, where there's 50 million ounces of gold were discovered. Or in British Columbia, you have the Golden Triangle, which is another very prolific area of gold. Problem with the Golden Triangle, it's all way up in the hills and the mountains. It's expensive to explore and discover and mine, but the grade's so high, it makes it worth it. But like that example that I gave you with Great Bear, that was in the Red Lake camp of Ontario. So there's these big camps. There's Red Lake, there's Timmins, there's Kirkland, there's Val d'Or in Quebec, there's the Golden Triangle in British Columbia. There's all these different trends in Nevada. But those are the best places and the safest places. If you're going to play the high stakes, high risk, high reward game, stick to Canada and specifically Nevada.
Yeah, and I guess another word you mentioned was high grade gold. So what does that exactly mean?
Yeah, that's a good question. There's in gold mining, there's 2 types of mines. There's the open pit, and then there's the underground. Now the open pit it's more disseminated. The gold has just been disseminated, and I'm not a geologist, so I'm not going to use big geology words for you, but the gold's disseminated at the surface, right? And it's in sedimentary rock, and it's all disseminated. And basically I call it dirt on dirt. So typically an open pit mine would have a grade of about probably 1 gram of gold per ton of rock. So that's kind of the standard right now. In fact, you can mine an open pit for as low as about 0.3 of a gram per ton of rock in places like Mexico and all that. So that's the dirt on dirt. Now there's also in this language, there's oxide, which is very easy to process. And then there's sulfide, which is typically underneath the oxide. And the sulfide is more expensive to mine and and process. So the ideal thing in an open pit is 200 meters of oxide, 1 gram of gold right at, running right to surface. And when they're drilling it, if you're drilling 100 meters of a gram, like you got that loose pasture, you drilled it and you go, wow, there's 100 meters of 1 gram gold right from surface. That's going to make your stock go crazy, right? Especially if you've only got 30 million shares out or less. So then your stock is really going to jump. It's going to go from 15 cents to $1, like overnight. And then you build that out, and then the hype gets, it can go all over the map. So, but in the open pit scenario, you're looking at around 1 gram per ton, roughly. Anything above 1 gram is fantastic. Anything below 1 gram could work, but it depends on where you're doing it. And is it oxide or is it sulfide? Then underground, you're sinking a shaft and you're going down and you're chasing these, in many cases like ours, which is a quartz vein system, these steeply dipping quartz veins that are probably 2 to 3 meters wide, and they're parallel. You're going to go down and then you're going to drift, and you're going to make tunnels and cut through these and go all the way down. And so there you need a grade of at least 3 grams per ton or 6 grams per ton. Like ours is 10 grams per ton, which is spectacular. So this is why we feel like we have an absolutely spectacular asset. The challenge with our asset was that we're not that oxide gold, we're sulfide, which is much more complex to process. So we're actually doing an interesting way of processing it. We're using biooxidization, which is basically using bugs, bacteria, to separate the oxide from the sulfide. And then you put it in a carbon and leach circuit, and then we're going to pour gold doré bars right on site. So ours is all fly in, fly out, and you're going to fly out with a gold doré bar, which is different than a lot of the mines out there. And it has its challenges as well. Back in the old days, this thing was mined in the 30s. They used to put it on concentrate in a barge and ship it to Washington State. But anyways, that's a very long story, but I digress. There's 2 kinds. There's the open pit and there's the underground. So those are the 2, and the grades mean a lot, because the higher grade means the more valuable each ton of rock is. And so how much is it going to cost you to get that ore? Is it going to cost you $200 an ounce, or is it going to cost you, $1,500 an ounce when I'm only getting, $1,800 an ounce for the gold? So now the other thing that's really important is where is the deposit? Because you often see people go, oh yeah, we hit 100 meters of 1 gram gold, which is great in an open pit, and it's in oxide, except it's down 500 meters. It doesn't start till 500 meters. Mm-hmm. So there's a thing called strip ratio, the waste rock for the actual mineralized rock. So a good one that's near surface, the strip ratio would be 1 to 1, 1 ton of waste and 1 ton of mineralized ore, right? But something that's way down here, I got to do, 7 to 1. I get 7 tons of waste rock to 1 ton of ore. So that is a huge effect on cost. So some of these tricky guys, and when they put out their news releases, like, oh, look at these awesome intercepts, and go stock, go headline, but they don't tell you where it is in the headline. And then you go in and you look at the table and you say, oh, that thing's 500 meters below surface. Or if it's an underground mine, they hit a spot here, but the next spot's way over here. You're gonna have to drift to, it doesn't all stick together. So the whole geometry is what's very important. You need to understand how is it mineralized? How is that gold mineralized? Is it at surface? Is it disseminated, or is it really high grade shoots? And can you get it all? Can you go down there? Did the mine 10 miles down the road? Is that how they did it? So that's also very important.
And I guess one thing I wanted to know is do companies face any issues with, is there a process to oversee this mining process that's going on?
There is.
Is there the actual miners, the people who do the heavy lifting? Is there a process where maybe they could use the gold mine or any valuable stuff mine, maybe steal it, or stuff like that, with a corrupt type of element, and the actual people who are working? Is that a phenomenon in this space?
Not in this day and age. I mean, there's placer gold and rivers and things like that, and I've worked for companies that are in China, and you have these artesian gold guys that just dug dug holes and ground down the oxide gold, but it's a lot of work, and it's too hard and too technically challenging to really achieve it or be a threat. I can say, hey, I've got 1,000,000 ounces of 10 gram gold. Well, no one's going to get that.
Yeah.
The only way you're going to get at is to raise $200 million and build a mine and a shaft and a processing facility, and then go through all of the proper environmental procedures and governmental procedures and regulatory issues. And, it's a lot. So short answer to your question is no, not these days.
Okay.
Maybe in places, in places like Mexico and things like that, where, you've got more artisanal kind of mining in third world countries, but you just don't see a lot of that. And the other good thing about Canada is Canada really is a leader in terms of the environmental side and the socioeconomic side, that, you can't, as a Canadian company, you can't go and, do a deal with some corrupt government to get a permit. While it might be okay with that government in that foreign country, that's not going to be okay with Canada. So, you cannot do that in Canada. It's monitored, and, you'll go to jail based on our laws. So, and then on the environmental side, I mean, nobody does more environmental work and studies and than the mining industry. I tell a lot of people that want to, they're into the environmental, they want to do environmental studies, and I said, well, go work for a mine. I'm like, we're going to need mines for everything, even the green future. You need mines to build all this whole infrastructure. We're going to need all this lithium for all these batteries, right? So it's, there's a hypocrisy out there that drives me crazy. There's a happy medium that, there's a way to do things and there's a way not to do things. And I think in Canada, we do things right and responsible. It's not perfect, but, there are measures in place.
Mm-hmm. And I guess one thing I just wanted to understand, like this concept of the value you get out of the gold or like any type of mineral that you mine. So like say like you discovered this large pot of gold, like wouldn't that bring the value of gold down? Like, so this is like my understanding of it, because now there's like more gold in the world. Or how does this like work? Like valuing gold, how does that
Well,
work?
gold's different because gold's not really a supply demand thing. Gold's a currency. And so it's not like copper. I mean, where copper is a definite supply and demand thing, there's going to be more demand. In the past, there wasn't so much demand, so they stopped making copper mines. And now there's a big demand and there's no copper mines. So we got to find copper mines, but they take forever. Copper mines take 10 years to do all the studies and build them, So there is supply and demand there. In gold, it's not a, India is big on jewelry and the demand of jewelry is going up, so the gold price is going to go up. No, gold is tied to the US dollar. There's a lot of macroeconomics going on in the world, but I can tell you the one thing, and I don't like to complicate things, the simplest thing about gold, it is always going to do, and you look at any chart, it does the exact opposite of the US dollar. So if the US dollar is going up, gold is going down. And right now the US dollar has been going up because they're raising interest rates because of this inflation. And so that's bad for gold. But if you look at, 2022 was just a disaster, right? Because the US dollar got stronger and stronger, and then gold and commodities come down. It's going to bottom out. And this has happened in 2011 and 2015. And it's happening again, I can tell you, because I've lived through, 3 or 4 of these cycles. And there's another big cycle coming now. And so once they finish all this tapering, so the EU, I think they bumped it 50 points yesterday, and then the US bumped it 25 basis points. There's talk of a bit more kind of interest raising this year, 1 or 2. Once that's done, and as soon as they drop interest rates, gold is just going to take off like a rocket, and that's what it's done. And I'm not saying that because I'm smart or anything. That's just what history has shown.
Mm-hmm.
So last year, it's a great time to look at gold now because it's taken such a kicking. The price of gold's not even that bad. Like I said, the average mine, it's $1,000 an ounce to mine it, and they're getting $1,800 an ounce. They're making money hand over fist. But there's the sentiment right now is not, it's a risky venture. It's perceived very risky. I think people learn now from Bitcoin, but the sentiment's not there. The price is there. The price is good enough to warrant making money, but the sentiment for the risk is not there, especially for the juniors, because a junior, you're out there, you got this piece of moose pasture, you're raising money, and you're, hopefully I hit something and hopefully I survive. You're never going to make a dime, right? All you do is burn money and pray that you hit gold, and then a bigger company will buy you out. That's you don't invest in a junior gold company to wait for it to become a mine. You invest in a junior gold company for them to discover gold and build it out, and then economically justify it, and then you're going to get out. So that's how you make money in junior resource stocks.
So how does this process work? Say like a Canagold, I guess we'll talk a bit about this in a bit more detail later on, but say like this company, they're mining gold, they're taking on money to actually like start the mine. They hit that pot of gold, but now like they're not discovering as much gold. So now like at this stage, the company stock price is up. Like what's the next step here? Do you look for new mines, or does it like just come straight down?
Absolutely do. Like even the biggest mines in the world, like Newmont just bought Goldcorp. I mean, those are massive companies, multi-billion-dollar companies. But to survive, you've always got to keep getting bigger. And so this is when the market starts to turn around, the sentiment starts turning around. The majors their stock price goes up. They've been making money, good money. They've been making good money lately. But like I said, earnings aren't necessarily tied to your stock price, right? So we're all part of this big ocean of the gold price and the gold sentiment. So they always want to keep getting bigger and bigger and bigger. So they've got another one on stream, as this one's going to be depleted. This is a 10-year mine life. We're into year 7. We better find another one. And if we don't find another one, in fact, they don't even look anymore. They let the juniors do that job. So they let all the juniors risk all their money and their lives and, to find or not find something. And if a junior finds something, then a mid-tier might buy them out, and then a major will buy that out. So majors are only interested in mines that, like Great Bear, the example I gave, they've defined probably 8 million ounces in that thing. But I can tell you that thing's going to keep going, and it'll have 30 million ounces over the course of its lifetime. You just can't prove that up. You're not going to drill down there to say, oh yeah, there's more below. There is, because that's the way those deposits work. So to answer your question, is you've always got to grow. Otherwise you're dead. Your stock's dead. So you're going to take your stock to a certain point. But if you're doing a good company I like is a company called Knox Gold that I invested in, and they just kept buying assets that were going to do about 100,000 ounces a year, which is what we're targeting at New Polaris. So the analysts and the bankers, they want to see 1 million ounces. They want to see 100,000 ounces a year for a 10-year mine life. That's kind of the magic number for a mid-tier to kind of take you out. And then what Knox Gold did, they found 5 of them, in North America and in Mexico, all over the place. And now they're doing, 500,000 ounces a year, So they're constantly trying to grow. And that's what gives us hope in the bull market. The bigger fish are eating the little fish, and then the bigger fish are eating that fish, and everybody's happy and everybody's making money. And that's very fun for probably a year, and then it all implodes. And then these guys stop investing in this, and then you've got a company where you've spent $10 million drilling. Your stock was at $1, but now it's at 15 cents, and now you got to try to raise another $3 million, but you were trading at $1, but now you got to raise $3 million at 15 cents. That's a lot more stock. Now you're diluting the stock, and it's never going to go up again. And that's why a lot of these junior companies fail. They don't hit it, or their timing's bad, or they don't get bought out because they don't make money, and then they fail, and most fail. So, yeah.
I guess let's talk a bit. So you mentioned New Polaris project. So I guess we'll give you guys a bit of context. So you're currently serving as the Vice President of Corporate Development at Canagold. So right. I guess we'll talk about that. So what is Canagold? Like in just like a sentence or two. I guess we're talking about it, touches that.
Canagold's an exploration company, but it's now a development company. So we're at that next phase. We found the gold. we've got 1 million ounces of high grade gold. It's 10-gram gold. And we know it's 10-gram gold because it was mined in the 50s. So we know we have that. So we're an advanced development stage gold company. And right now we're doing studies. We're now at the stage of doing a full bankable feasibility study. We already have a preliminary economic assessment. So you go to a preliminary economic assessment, then you do a pre-feasibility study, and then you do a feasibility study, and that's the bankable one because that has the most amount of information and data and all that. So we've been around a long time. This asset's been around for a long time, and there was some hairs on it. There were some issues with it, but we've overcome those issues, and so now I think we're ready to build it. And we're going to build it. We're going to finish the feasibility study this year, and then it'll probably take 2 years of permitting, doing studies and everything with the government, and doing all the community relations. So we'll be building a mine. We'll start finance the build of the mine as soon as we get the feasibility study out.
So just one question here, when you mentioned permits, so the government essentially like owns this land, so this is their country. So do you guys does the government take a percentage of whatever you discovered like on that piece of land, or how does this work? Or they just let like
no, the government takes taxes when you're actually starting to get revenues. But there is claims fees, so that does go to the government. I'm not sure about exactly how it works with First Nations on that regard, but the stuff that we have is on Crown land, but it is on the traditional territories of the Taku River Tlingit First Nations. So we work with them, and there's ways that we can compensate them and employ them and all that kind of thing. So we're lucky we have good relationships with that group. So it's very important that you the last thing you want to do is ignore the First Nations and just do your thing and push it through whatever you can with the BC government, because that's not going to help you get your permit, and it's not fair anyways. So you work with the local community and get that buy-in with them, and then it makes it easier for the government to approve what you're doing. That being said, politics is one thing. The environment is the environment. Doesn't matter who's overseeing it. There's acid rock drainage in mining, right? So you need to mitigate that. And it doesn't matter what your politics are. Acid rock drainage is not a good thing. So, what we do is, for example, in our mine, it's a past producer. We don't need to make a big, massive open pit. It's just a shaft that goes underground. We're going to take the waste rock out, but then we're going to put half of it back into the mine. We're going to mix it with cement and pour it back into the mine. And then the other half we put onto a clay barrier inland, away from streams and rivers and waters and lakes, inland, and it lies on top on a dry stack, it's called. So that's what we're doing to mitigate any kind of environmental impact. And that's the kind of stuff so the whole environmental, and then working with the local communities, this is what's become so important in mining now. It's called ESG. And E is environmental, S is for sustainability, and then G is governance. So you work in all those areas, and now there's funds out there. If you want to raise money, you need to raise 5-10 million to do all your drilling. Well, a lot of the funds out there now insist that you have good ESG practices, and you've proven that you're a responsible miner and you're a responsible exploration company. Otherwise, they won't fund you the money. I just saw some stats on it, and the pool of funds available has doubled in the last few years. Yeah, based on the ESG. Yeah.
Yeah, because I was about to ask that as well, if that's like a self-imposed type of thing that companies do, like following good practices. But I guess it pulls in investors. So.
Well, like I say, Canada's very much a leader in this area, and there was this disaster called Bre-X in the 90s where that was a big scam. They salted the gold assays. They basically sprinkled it with gold dust and said, hey, we've hit this amazing high grade gold, and the stock took off, and then they found out the whole thing was a big scam, and the stock tanked, and some guy ended up thrown out of a helicopter. It's quite the story. So since then there was a lot of regulatory on how you report your drilling, report your findings, report your economics. That's not the environmental side. That's more of the standards of reporting information in this industry. but that's also spawned the whole standards of environmental practices as well.
And sorry, what was the name of this incident that you mentioned, the scam?
Oh, BREX.
BREX, okay.
Yeah.
Maybe I'll
It's
show a couple
BREX.
pictures.
It's a very infamous story. The movie Gold is based on it. There's a movie with Matthew McConaughey. It's called Gold, and it takes place in the U.S., but it's based on BREX, which happened in Indonesia, actually. But all of the exploration guys were all from Vancouver. The geologists were from Vancouver, and the promoters were from Vancouver. But so anyways, that was kind of spawned this whole NI 43101, National Instrument 43101. So when you have a resource estimate, we have 1 million ounces of gold, and that's NI 43101 approved, meaning that you've had a third party look at this thing, look at your data, look at the spacing, look at the drill intercepts, and said, yeah, okay, that looks like that looks right. So there's a lot of checks and balances, and I've worked in biotech and technology and in food and a lot of different industries. Mining is the one that has the most oversight in terms of how you report information.
Yeah, and I guess moving on with Canagold, so you work as the VP of Corporate Development. So what exactly are your responsibilities there?
Well, when we're trying to raise money, I'll go to the institutional funds. So they're buying stock wholesale, right? So I'm trying to raise $10 million, right? And I want to do that with as few people as possible because that's a lot of work. So you go to find these gold funds that invest. They're going to cut checks for $100,000 to $500,000 to $1 million, right? So I work with the CEO and we march the company around. We tell the story. Let's say we're trading at 50 cents. Then we'll give them a discount because they're going to be spending $1 million, right? So we'll give them a discount, plus we'll give them a warrant, which is another thing. It's a tool that allows them to buy stock at a cheaper price moving forward. And so we kind of I sell that with the CEO, and we raise that money. And after that money is raised, then we're traded on the Toronto Stock Exchange, and the whole world's out there. So now you can digitally market this. You can go to trade shows, you can go to mining conferences, you can have newsletter writers, you can do digital ads and digital marketing, and there's rules about how you do all that stuff. So then I spread the news to the masses in order to get the stock price up, so the guys that came in at the wholesale level can get out. Right? So that's kind of how it works.
And I guess the main selling point of Canagold is, as you mentioned, this project that they're working on, New Polaris. Maybe you can give a bit of information about that to the audience.
Yeah, so Canagold trades on the Toronto Stock Exchange. The symbol is CCM. We're at the development stage. We're taking it from we have 1 million ounces of gold. We're just going to take it up to a higher level of confidence. We're building a mine. We're doing all the engineering studies and all that. Where the investment excitement in something like this is, if you look at your enterprise value per ounce of gold in the ground, we're probably getting like $20 an ounce right now, based on the number of shares that we have out, our market capitalization divided by the amount of gold that we have, works out to about $20. Well, when you have a feasibility and a permit, you're usually in the $80 range. So we're going to get reevaluated when we do a revised resource estimate, which is going to show more gold at a higher confidence level. And then we're going to do our full feasibility study, which is going to show you all the economics. And then we're going to be moving forward with the Tackle River Tlingit First Nations and our community relations. So what we're doing is we're de-risking it. We're saying, okay, there's definitely 1 million ounces there. It's definitely 10 grams gold. We can definitely mine it. We can definitely get it permitted. So as we prove all this, that's going to take our valuation from $20 an ounce to, well beyond. And so that's what you're buying right now. And you're at the bottom of the gold market. And we've just had a nasty situation. Nobody cares about exploration or even this asset. But that's going to turn around now because as I mentioned, once they start lowering the interest rates, gold's going to start taking off, and the sentiment will come back. And then the majors will buy the mid tiers, and the mid tiers will buy the juniors, and everybody goes up, and then everybody looks smart for a while.
Then it all comes down.
you gotta time this stuff. I'm gonna have to go soon, so
sure. Yeah. We'll just end off with just this question. I wanted to know. So you mentioned so when a company is starting this new project and then they tell like to pull in investors, they give an estimate, like we estimate this tons of gold here. Are they always selling it like on the high end, or like they do like an underestimate?
They don't do anything because they can't say anything until they have an actual NI 43-1 report. So I can drill, I can do 5 drill holes that are 200 meters of 2 grams, and they're this close together. And I was like, okay, is that 200,000 ounces? I don't know. Then you have to do a study to look at all the data. And only when you've done the NI 43-101, when a third party looks at that study, they say, yeah, you got 200,000 ounces at 2 grams gold. Now you can say it. So you can't say it, and you can't say that until you actually have it. So you could say, oh, we've done tons of drilling here. We know it's there. We got all these intercepts. And, you know, we did our own calculation. It's 500,000 ounces of gold at, 2 grams. You can't say that because you don't have a report that says that, a third party report. You get in big trouble. You get your stock halted, and you get in trouble with the Securities and Exchange Commission, and your stock goes down to 0. So you got to be very careful. You can only tell what you know. I mean, you can kind of say, hey, we've got an NI 43-101. We've got the 200,000 ounces at 2 grams. It's near surface. It's oxide. It's right next to this big mine. You can kind of give it that kind of razzle dazzle. The razzle dazzle for us is ours is a past producer. We've already proven that you can mine the thing at 10 grams. They did it in the 50s. and we've already got a preliminary economic assessment. I'm sure our numbers are going to go up. Our costs are going to go up and all that. But our assessment was done at $1,500 gold. Now we're going to do the assessment at $1,800 gold for the feasibility. So that's going to give you some more gravy. So stay tuned. But I think we're in great shape because our largest shareholder basically staged a proxy, overtook the board and the management, and they're going to fund this thing all the way to feasibility and permitting. So that's the other thing. We're not going to disappear. We've got a white knight backing us. So.
And I guess thank you so much for your time. We'll just end with just super quick one. So if you can summarize under a minute, any advice that you have for individuals that are considering investing in like mining or resource companies, like what should they be looking for in a company and it's like its management?
People, project, place, right? So find a management team with a good track record. Find a project that's near other mines or on a similar kind of geology and place. Go to a risk-free jurisdiction where you can actually build a mine and get it permitted. So there's that. But then there's thousands of these companies. So I recommend looking at newsletter writers. There's a lot of really good newsletter writers. There's a lot of those newsletter writers are listed on the big forums in Vancouver. There's the Vancouver Resource Investment Conference, which is one of the biggest mining conferences in the world. There's the PDAC in Toronto, which is another conference. So seek out those newsletter writers because they're already kind of narrowing it down. And then anything you read about a company, look at the bottom. Do they hold stock? Do they have stock options? So a person that does not hold stock is going to be more an objective opinion. But if they bought up, they've loaded themselves up with the stock and then they're promoting it, then they've got their own self-interest whether or not the company is successful in the long run or not. So follow the newsletter writers. There's good websites like ceo.ca and Stockhouse and Stockwatch. There's a really good newsletter writer that I like, and a guy named Jeff Clark. He's got the Gold Advisor. He's an independent guy that knows good management. That's just an example. Or you can go to the websites of the Vancouver Resource Investor Conference, or go to the Metals Investor Forum. Some of the best newsletter writers in Canada are on that forum. Find out who the newsletter writers are and follow them. Or there's an investing news network. There's a bunch of mining portals to look at, but don't take everybody for their word. Cross-check. We could do a whole other webinar and all that, but people, project, place are the main things.
And for the audience listening, I'll link down everything that you've mentioned, all the resources in the description down below, so you guys can check it there. Thank you so much, Mr. Henderson. This was a super knowledgeable session. Like, this is something I've been like personally interested to learn about this as well. So thank you so much for doing this, and I hope you guys have enjoyed as well.
Yeah, well, thank you.